Welcome to this session on distribution to shareholders. In corporate finance, one of the central questions firms face is how to return profits to their shareholders. Should they pay dividends? Should they repurchase stock? Or should they reinvest profits back in the company? In this lecture, we'll explore dividend theories, payout policies, stock repurchases, and valuation impacts. We'll also analyze how some real world companies like Apple, Coke, and Microsoft handle distributions. By the end, you should understand how these policies connect directly to firm valuation and shareholder wealth. The foundation of value in finance is free cash flow. If you recall, firm value is the present value of the expected free cash flows discounted at the weighted average cost of capital. If a company generates excess free cash flow but lacks profitable investment opportunities, managers must decide whether to hold cash, pay dividends, or repurchase stock. For instance, Apple generates hundreds of billions of dollars in free cash flow annually. Instead of hoarding it, Apple has chosen massive repurchase programs to return value to shareholders. This demonstrates how free cash flow decisions directly influence shareholder returns and perceptions of value. So, what is distribution policy? It really is three things. It's the level of cash that's distributed, it's the form, dividends versus repurchases, and it's the stability of that distribution. Coca-Cola has maintained a steady dividend for decades, appealing to income-oriented investors. In contrast, Apple, Alphabet, Google's parent, resisted dividends for years, using stock repurchases to return cash selectively. The choice reflects strategic positioning and investor expectations. Dividend yield equals dividends per share divided by stock price. Dividend payout is the dividends divided by net income, or dividends per share divided by earnings per share. Again, industries differ widely. Utilities like Duke Energy have high payout ratios because they generate predictable cash flows but face limited growth. Tech firms like Amazon rarely pay dividends, preferring to reinvest earnings into expansion. Again, these contrasts show how industry economics shape payout norms. The debate has persisted for decades on what investors want. There are three key theories to dividend distribution. Dividend irrelevance, devised by Modigliani and Miller, proposed that payouts do not matter. They're not important. The bird in hand theory says that investors prefer certain dividends now over uncertain capital gains later. That is, they prefer dividends. The tax effect says that dividends prefer low payouts due to the tax deferral benefits of capital gains. Each theory has empirical support, but as you can see, they all three say something different. So in reality, it's really more context that's important than these theories individually. Taxes, investor preferences, and market conditions all matter. The dividend irrelevance theory was proposed by Modigliani and Miller. This theory argues that the payout policy has no impact on value in a world without taxes or costs. Now, investors can create their own dividends by selling shares or reinvesting dividends if they don't need cash. So imagine you're an investor and the company wants to return investment money to you. In a world with no taxes, would you care if it were an interest payment or a dividend payment? With no taxes, you wouldn't care. You get the same cash flow either way. Would the company care? Again, with no taxes, they also wouldn't care. So, just a logic, right? Little intuition tells me that if nobody cares, there probably isn't going to be an impact on value if we change the policy. So, what happens is that if you borrow more, it's cheaper, but the risk to shareholder goes up. So, the costs of financing offset each other, and the weighted average cost of capital doesn't change. So, there's no change in value. Again, although it's an unrealistic in practice, the theory provides a baseline for analyzing how taxes and frictions influence real-world payout policies. The dividend preference theory, sometimes referred to as the bird and ham theory, argues that investors view dividends as safer than uncertain future capital gains. A guaranteed dividend today reduces perceived risk. The risk-return trade-off concept says that if risk increases, investors want a greater return. As required return increases, the value decreases. So dividends are less risky than capital gains. If we maximize dividend payments, we will be reducing perceived risk. That should maximize price. Procter & Gamble, over the last 65 years of consistent dividend increases, illustrates this. Investors value that reliability, which lowers P&G's required return and supports a premium stock valuation. The tax effect theory says that investors may prefer lower payouts because dividends are taxed immediately, while capital gains taxes can be deferred until shares are sold. Historically, U.S. tax laws tax dividends at higher rates than capital gains. However, after 2003, tax cuts equalized these rates. So many companies like Microsoft increased dividends. No one really wants to pay taxes. Dividends are taxed immediately. Capital gains taxes are delayed until the investment is actually sold. So increasing dividends are not desired, so the value will decrease them. Again, this shows how policy changes reshape corporate distribution strategies. Now, what does research tell us? Research finds investors often demand higher pre-tax returns from high payout companies, consistent with the tax effect theory. That is, they want to be paid more to compensate for the need to pay taxes on the return. However, taxes alone cannot explain differences in valuation. Other factors like investor protection, agency costs, and signaling are also critical. Tax environments also shape policies across countries. In Germany, where dividends faced higher taxation, firms leaned towards repurchases. In the UK, where taxes on dividends were lighter, dividends were more common. Again, this illustrates how global differences in tax law drive corporate choices on shareholder distribution. As we all know, from time to time, legislature makes changes to the tax code. Not very often, but they do make changes. These impact everything we do, say, and buy. Are shareholders protected from agency costs? The greater the regulation, the more likely agency costs will be minimized. If you have poor protection, high payout companies will be more highly valued. The price will be higher. Again, why is that? Again, people seek safety. It is safer for them to have the money than for the money to be left in the hands of the corporation. So, what's the summary? Taxes certainly affect dividend policies chosen by companies. There is evidence that investors prefer to avoid taxation. There is also some evidence that investors require higher pre-tax returns on stocks with big dividend payouts. And we'll continue this discussion in the next video.